Hello and welcome back to my channel. On this channel, I share my personal investing journey with full transparency. If you are tuning in for the first time, I encourage you to explore my YouTube channel for my transparent portfolio, information about my portfolio updates, company analysis, and more. To get my valuation Excel sheet used for MGL valuation calculations, do comment your emails. I will send it right away. Before we get into this video, let me clarify that I am not a SEBI-registered advisor. Everything that I share here is through my personal experience, and nothing in this video should be taken as a stock recommendation. Do your own research or consult a financial advisor before investing, and avoid acting on any stock tips you receive. Now, let me talk about what Mahanagar Gas Limited do. When you think of clean and efficient urban energy in Mumbai area, one name that stands out is Mahanagar Gas Limited, or MGL. At its core, MGL is the city gas distribution business. It delivers compressed natural gas for vehicles and piped natural gas for homes, restaurants, small businesses, and large industries across Mumbai and also its surrounding regions. But MGL doesn't just sell gas, it builds the entire infrastructure behind it, from laying down pipeline networks to setting up CNG stations. MGL ensures the supply is safe, reliable, and always active. More importantly, MGL plays a key role in India's clean energy journey by pushing natural gas as a cheaper, greener alternative to petrol and diesel and LPG. It's helping reduce pollution and shift the country towards a more sustainable future. Now, coming to the main part, for valuations, we will go deeper into only the discounted cash flow method, which is more futuristic in nature. I do it in a way of Professor Aswath Damodaran, who is also known as Dean of Valuation. I am calculating this valuation as of 11th July 2025, so most of the values are as of that date. Discounted cash flow valuation is basically finding the current value of all the future cash company is expected to generate. But because money today is worth more than money tomorrow, we discount those future cash flows back to today's value. If we check where this company lies in terms of business life cycle, it is halfway through the growth phase. I have tried to fit it according to recent 3 years average growth rate for revenue, profit, and cash holdings. Based on this, I choose to go with bottom-up approach for MGL's valuation. If the company was in the initial phase where growth rates are extreme, like for startups, I would have preferred top-down approach. Now proceeding with the bottom-up approach, we can take the recent 10-year bond yield from the RBI website to be 6.33% and deducting India's default spread as per Moody's rating, we get the risk-free rate to be 4.15%. For the equity risk premium, I also went through the revenue division of MGL's business. All the revenue is from Indian market itself. So the equity risk premium taken from Aswath Damodaran's website is 7.26% as per the latest data. For beta calculations, there were several methods, but bottom-up betas are more reliable than regression betas. As MGL's business is into the oil and gas distribution side, the unlevered beta for that sector is 0.86. Now, relevering it using the market values of the company's debt to equity ratio, we get the levered beta to be around 0.87. Having more debt will increase the levered beta, thus reducing the overall valuation of the company. So, companies with high debt are considered to be more riskier. Now, calculating the cost of equity using capital asset pricing model, also known as CAPM, it comes out to be 10.45%. The cost of debt is not calculated based on interest rates of the current debts of the company, but rather its credit rating. CARE has given AAA rating to MGL's loans, so its default spread is 0.45%, and the cost of debt is calculated as the sum of 10-year bond yield plus the default spread. As this debt is helping save taxes for the company, the after-tax cost of debt is considered for further calculations. Now calculating the cost of capital, which is also the discount rate, using the weighted average cost of equity and cost of debt using market values of debt and equity, we get the discount rate to be equal to 10.39%. Now to calculate free cash flow as well as the reinvestment rate, we need after tax EBIT, and it is 1054 crores in value. Return on capital is calculated based on book values of net debt and equity, which is very good for MGL with 18.37% returns. Reinvestment is calculated as capex minus depreciation plus change in non-cash and non-debt working capital. But here I have calculated the 3-year average reinvestment rate as well as the current reinvestment rate, as the growth for next year will be based on current reinvestment rate and then the average growth rate for further years. As you can see, MGL has recently reinvested 73.52% of its long-term growth, and with 18% returns, the cash flows are bound to grow exponentially. The growth rate comes out to be 13.5% for the next year and 14.6% for the further years. And the free cash flow for the financial year 25 was around 280 crore rupees, which over time increases, and when we discount future cash flows to the cost of capital, we get the current standalone value of equity to be equal to 14,000 crore rupees. Also, adjusting for consolidated value, I have used asset multiple to calculate the values of subsidiaries, and the consolidated value of equity comes out to be 14.2 thousand crores. In per share value, the intrinsic value per share of MGL is 1437.6 rupees, which is 3.37% above the current market price. So, as per my valuations, MGL comes out to be fairly valued company in the market. I will be sharing free Excel sheet of these valuation calculations. Share your email ID in the comment section now. If you haven't subscribed to my channel yet, do it to keep updated with my portfolio. Until next time, stay invested.